Okay. The next part I would like to talk about is assessments. Okay, now for assessments, we've basically got three types of three categories of assessments, and for each of these you would have an original assessment. Now what the importance of the original assessment would be, from a timing perspective, we're going to look at these periods when the assessments remain open and when SARS can issue additional assessments. So from a timing perspective, once an original assessment has been issued, that time period starts running, where there would be 3 years or 5 years for SARS to go and make changes to. And what, in a strange way, one quite often finds is that a lot of these additional assessments and the audits and investigations happen quite towards the end of the period. So in quite a few instances, it becomes very relevant as to whether the 3 years or the 5 years have passed now or not. Okay, so the original assessment, if the taxpayer has to submit a return and would then be assessed by SARS, this original assessment would be the date on which SARS issues your assessment. So for income tax as an example, once you've submitted your return and you got your assessment back, the date of that assessment, that's your original assessment. From there on, your period starts running. If the taxpayer had to submit a return that he completed himself, and that's basically a self-assessed tax, then, so that as an example, the date on which you submit your return and you submit the self-assessed tax return, that's your date of the original return. So that's when your period starts running. And then something that the Act makes provision for, as far as I'm aware, we don't really have it. There's some taxpayers who don't have to submit returns, as we spoke about earlier, but that's not quite what they had in mind here. But in future, the Tax Administration Act allows for people to pay certain types of taxes without a return, and the mere payment of the tax would be sufficient to say that you've done what you should. If you ever had to deal with a tax like that in future, the date when you make the payment, that's your date of your original return. Okay, on these original returns, there's another form of possibly an original return, if you want to call it that, but where you've not submitted your return or you've submitted an incomplete return, SARS is allowed to issue an estimated assessment. You then get an opportunity, well, you then have to submit a return to correct what they've done if you don't agree with that. If you don't submit a return once an estimated assessment has been issued, that becomes your final return. So then that's it. If you don't correct your non-compliance, then you're stuck with that return. Okay, with the aspect where I would like to go with this whole discussion is to talk about additional assessments. So quite often after you've had the request for information, where you provided the information to SARS, or where you've been audited, you would find that there's an additional assessment. From a legislation point of view, the system says that if SARS finds something during this audit or the request for information, they must send out or they must raise an additional assessment. So there's no option for them, or you can't dispute with them. Probably getting back to the point that we discussed a bit earlier, there's no point for you to say that you don't agree with what they're doing. As soon as they found something that they believe is to the disadvantage of the fiscus, then they have to raise an assessment. On this again, we've already spoken about the issue, but I would like to just mention it again. From managing your own practice perspective, you'd have to find a way of making sure that you go through these e-filing profiles on quite a regular basis to see when these additional assessments have been issued, or then make sure that your contact detail, the contact detail on the bottom of the return on that initial return would be yours, that you would at least get the notification there. I'm not sure that that's really enough to say that you will definitely get the notification, but you have to have some sort of a way of checking your clients' profiles to see have they been assessed or not. So it's something that at the moment a lot of practitioners are missing, that these things have been issued. And that actually makes it quite difficult to give the best service that you can to your clients. Okay, the time limits on these assessments. So any assessment that's been issued, and the question is really, when can SARS no longer issue additional assessments? So we said now if they've done an audit and they found something, then they must issue an additional assessment. When can they no longer issue an assessment? For an original assessment where SARS assessed the amount, so for income tax specifically, 3 years after the original assessment date. So 3 years from the original assessment date, after that SARS can no longer issue further additional assessments. On VAT, the rule, or self-assessed taxes rather, not only VAT, but on self-assessed taxes, the rule is 5 years after the original assessment date. Similar for these types of taxes that would come with, as soon as you've paid, you've got an original assessment. Then also, there's another category here that says that if SARS assessed you in terms of practice generally prevailing at the time when you were assessed, then they can't go and issue another additional assessment on that aspect in terms of something that's now contrary to that practice. So if you've been assessed in terms of practice generally prevailing, then you know that that assessment on that aspect cannot change. And we're going to look at what this practice means on the next slide. And then obviously, if a process has gone through, or an assessment has gone through a process of dispute resolution, where you've, let's say, you've convinced SARS in the objection process that an amount shouldn't be taxable, then they're not allowed to raise an additional assessment on that aspect that you've concluded during the dispute resolution. Yes? Okay, that's a very good question. Okay, the question is, does the audit process impact the 3-year rule? And I think in practice, that's a question that a lot of taxpayers seem to have, or an impression that a lot of taxpayers seem to have. Once you audited, you're out of the woods and you're fine. Unfortunately, these are the only things that would close the period. The fact that you've been audited doesn't mean that you can't be audited on that same assessment the next year. And the fact that you got away with something in the first audit doesn't mean that that aspect is now cast in stone and it cannot be changed again. So in short, the answer is an audit doesn't close an assessment or an aspect of an assessment. So the fact that you've been audited just meant that for this round, the tax auditor was happy. That same aspect that was audited could be, an additional assessment could be raised by the next auditor if they don't agree with what the first auditor had. Mm-hmm. Okay. Yeah. Okay. The question is, if your 3-year, let's take the example of a 3-year period in income tax, if that is passed, can you basically refuse to give SARS further information because they can't raise an assessment in any case? The answer is that what they're looking for in that case is probably to see, and we'll talk about it just now, that these rules only apply if there was no fraud, there was no misrepresentation, and there was no non-disclosure. So what they might be looking for in that instance is to say, but if they can find something in that information that you're giving them that indicates one of those 3 things, then the 3-year rule doesn't apply. Then they can still go into, and they can still raise an assessment even after 3 years. So I think the purpose of them asking information like that would probably be to say, but can they possibly say that there's been misrepresentation as an example, and therefore the 3-year rule doesn't apply. So I think the purpose there would be firstly to see, can they get past the timing rule, and only then it would start being to see, can they raise an assessment again. So the purpose of the investigation might be a bit different, but so to answer your question, I don't think you can really say that you're not giving information because you passed the 3-year period. There's other reasons why they could be asking that information. So yeah, if it's something that was clearly disclosed and there was nothing that keeps this period open, then there shouldn't be any grounds. I think where it becomes even more difficult, and unfortunately I don't really know what the answer is, but I'll talk about it when we get to the exception to the rule, otherwise I'm running a bit ahead of myself now. Yes. No. It's still the original assessment, yes. Maybe just one last thing I would like to point out to you while you're asking the question now. Let's say you had dividends tax, so you've got a debit loan, there's deemed dividends on it, and you have to declare those deemed dividends for dividends tax purposes. You never submit the return. Are you at risk only for let's say we see dividends tax as a self-assessed tax, which it would really be. Are you only at risk for the 5 years, or are you at risk for a longer period of time if you never really submit the return? If you had let's say you had the debit loan, there was deemed dividends on that, but you decided you're not going to submit the dividends tax return. So are you at risk for only a period of 5 years for SARS issuing additional assessments for that dividends tax, or does it go longer than the 5 years? You haven't, okay, firstly you haven't disclosed it, so that would mean that you fall into that category where it's not closing out. I think going back even one step further than that, would that dividends tax assessment have an original date? So you didn't submit the return, you didn't pay the tax, there's nothing to start to get your original date there. So your original date would be the first time that you actually submit the return or that you pay your taxes. From there on, your 5 years would start running. So not submitting a return, if your client wants to work on that basis, would probably mean that it's not only 5 years, it's all the way back to when the client should have paid the tax. An interesting question, and I wanted to only bring it up a bit later, but I think it's relevant here as well. The Tax Administration Act says you have to keep your documentation for 5 years. So that makes it difficult again. So can SARS go back further than 5 years if you're not obliged to keep your documentation for something where you've never submitted your return? Okay, and there's an exception to the rule. If you've never submitted the return, then that 5-year period also doesn't start counting. So where you were supposed to submit the return but you didn't, you have to also keep the documentation basically going back for whatever period you have. So the 5-year rule doesn't start there. Where it becomes a bit more complicated, you've got your 5-year rule, you did submit the return, but now there's something that SARS believes that there could be misrepresentation or possibly even fraud afterwards. So let's say in year 6 you did submit the return for VAT, you've kept your documents for 5 years. Now in year 6, SARS requests you for information to see, can they go past the 5 years here? So can they show that for some reason your 5-year period didn't close? That's the more difficult question is, can SARS really request information from you that you're no longer obliged to hold? And unfortunately, I don't know the answer there. Quite a good comment that came from our master's class on Saturday was that if you look at other legislation, so if SARS asks for the right documentation, so something that has to be kept for 7 years in terms of the Companies Act, or if you're looking at documents that would be relevant to fraud investigations, there's a period of much longer than 5 years involved there. So I think the answer would probably be, depending on what the documentation is that's being requested, you can fall back to say, but you should only have kept it for 5 years, or SARS might be able to say, but there's other legislation that says you should still have it. But that becomes a difficult question then. If you did submit a return, and SARS is now establishing, can they go further than the 5 years or not? Okay, so unfortunately there's no answer on that. I also believe it is something that is being looked at, whether it's possible to ask that question or not, and that there are some cases that's in progress at the moment. Okay, the practice generally prevailing that we spoke about, so the importance of this, just to give a step back again, practice generally prevailing means that if you were taxed in terms of that practice, then that part of the assessment cannot be, there can be no additional assessment for that. Now, practice generally prevailing, the definition is that it's the practice as set out in an official publication regarding the application of an act. And that official publication, there's a definition for that. It's a binding general ruling, an interpretation note, a practice note, a public notice by SARS, a senior SARS official, or the commissioner. So these things would once you've been taxed in accordance with that, you would know that there can be no additional assessments to that part of the assessment that was raised. Okay, the important question here is what is not there that you would also use quite often in your practice, or if you're involved with the company in setting and determining what your tax positions are. If you look at something like binding private rulings on specific matters, I think the principle there is in any case that ruling is only binding towards the person who applied for the ruling, but still quite often it gives you an indication of what SARS's view on a specific matter would be. That's not there. So even if one person applied for a ruling, you followed the same route, and you were assessed initially in terms of that, there's still a risk that SARS can go back and raise an additional assessment if they don't agree with what you're doing. The other one that's quite notable that's not here would be all of your guides issued by SARS. So if you take I think it's about 900 pages of capital gains tax guide now, if you follow that capital gains tax guide and you're taxed in accordance with that, there's nothing that says that SARS cannot have a different view in a year's time and that they will be bound by what their view was initially in that guide. So the guides would probably be something that's good to consult, but just know that they don't give you the same type of protection as an interpretation note or a practice note. Your practice generally prevailing would cease once there's been an amendment to the legislation, or if you're relying on a court case, or the publication refers to a court case, if that principle is overturned in court, then the practice there would cease to exist. Okay, just a few words on these guides and the documents that are not necessarily binding. Perhaps before I go there, if we look at these something like a practice note or an interpretation note, does this provision that we've got here, does this say that SARS must tax you in terms of the interpretation notes the first time? So what this is really just saying is that where you have been taxed in terms of an interpretation note and you've been assessed based on that interpretation note, SARS cannot turn back. There's nothing here that says that SARS is bound by the interpretation notes. I think in practice I've rarely seen them deviate from the interpretation notes, so it wouldn't make sense to set a practice and then not follow that. But this doesn't say that SARS is bound by the interpretation notes or the practice notes. So I would just like to stand still a bit on what exactly would the status of these interpretation notes and practice notes then be when you assisting your clients with tax planning. So there's a court case there where the judge then also said that the departmental practice, which would be the practice notes and the interpretation notes, that's not necessarily binding towards SARS. So if they want to, they can deviate from their practice. But it would make common sense to go and look at those practice notes and the guides very carefully before you advise a client. So I think in that regard, even though it's not binding, it would be very wise to go and still consult these things when advising clients. And you'd often find that a lot of the issues that you're wondering about, the answers, other taxpayers have also thought about it and struggled with it, and you'll find the answers in these practice notes. Then, just if you find something in the practice notes that you really don't agree with and that you believe is debatable, there was another case, the case of Ernst, and what was said in that case was that a practice note, the same way that it's not binding there in the first case, even if it's been the practice of SARS for 20 years to apply a practice note in a specific way, if the wording of the legislation says something different to the interpretation note, so if that interpretation note is in conflict with the actual wording of the legislation, then eventually you'll be taxed in terms of the wording of the legislation, not what the practice note says. One practice note where I've had quite a few clients saying that they believe that there's a lot of different views on that. There's, if I'm not mistaken, it's number 78, the one on section 24C. There's quite a few things in that practice note where I think it could be debatable what's being said there. So from a practical perspective, consider what's there, and if you differ from that, then you must have a very good basis to support your argument. But there's nothing that says that the courts will, if it goes that far, will also tax you in terms of the practice note. The practice note is just guidance from SARS. Okay, the time limit